Stock started the day on a pretty down note, but got a boost from the statement, from the FOMC statement, that they were going to have some flexibility in those rate hikes going forward, and looking at lags and cumulative effects and lots of key buzzwords here and there. And then Powell stepped up to the podium, and we were doing okay for a while. But then he had to kind of remind everybody what he told us at Jackson Hole and what he's reiterated since, that this fight with inflation is not over, and that anyone who expects a pivot or a pause anytime soon shouldn't. And the market didn't like that. After multiple weeks of pricing in a Fed pivot and kind of getting one in the statement, kind of got that slapped down by the Fed chair and this press conference. So we're going to break down what the significance of what happened. We're going to break down the technical significance. So what did it do to the charts? How are the signals differing from one index to the other? They're not all performing to the same degree. And why is that significant for us? We're going to break down the sector moves and which ones performed well, which ones didn't, and is that how telling that is? And then our trade idea of the day is a stock that's has a pretty interesting bearish candlestick pattern. We're going to look at some of the other technicals as well and talk about how to do a bearish setup for it. So let's go ahead and get started. Today is Wednesday, November the 2nd, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here in the bottom right corner of your screen, or the red subscribe button. Click the thumbs up icon down there to like our video. Comment on anything that stood out to you as well. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook Live and upcoming events. Come down here to the bottom, click that heart. It opens up this tab. Hit that like button. Click this thumbs up icon. It opens up another tab. Hit that like button. We got to 100 likes, so right on the dot. So thank you all very much for doing that. Let's see if we can do that again. It's our goal every video is to try to get 100 likes on these. You can do it. You can click on these right now while you're watching. Also wanted to give a shout out to Scott Wilson. Thank you very much for the support on the super thanks here. This is how you can show your support for our channel. It goes a long way. We really appreciate it, and it kind of shows us the value that we see that you may be getting out of the videos that we put on this channel day in and day out. All right, let's start off taking a look at the S&P 500 with the market forecast indicator, and it followed through on yesterday's selling and broke down today. We talked about this in our class today, 3,800. Basically, these lines, it was really important that we hold those lines. We ended up breaking down by about 40 points with this 96-point range today. Pretty bearish. Again, it throws open the possibility that this was a fake out again. The break above 3,800. We've seen multiple fake outs this year. The one in March, the one here was very notable breakout, and then the one here. And as of right now, and again, very similar characteristics to the breakout here to what we saw in August, especially with the lack of breadth and the lack of volume to support the rally and that you typically get when you're coming off of intermediate lows or off of market sentiment lows. The intermediate line obviously made its way into the upper reversal zone, so it's definitely been a bullish run. So this is hardly like we've had since August the 12th, so we've going on a month, we've had a pretty good run. We didn't get, we only got a couple of days of dark green shading in the green line. We're already back down below the 2.5% mark. So just like that, that's, it tends to happen when you're starting to pull back, especially when you've been well above it, right? You might not, if you don't get above it, you might not, but so you don't have to get above it when you're on a bullish trend, but you do when you're trying to reverse a trend. And you're already back below it. We've seen that, like I said, to be bearish in the past. You can see the momentum line dipped all the way down to the lowest, extreme lows. And the near-term line dipped after forming a divergent high point, a higher high, and that it actually happened to be a bearish high point because it dipped its toe above 80 for a day, and then it was already back out of bullish territory. So it's a pretty bearish near-term peak, and then you add on that it was a divergent peak with these higher highs, and you add on the potential for a fake out, getting above resistance and then breaking back down very quickly. throws open the door that the intermediate line is probably going to make its way back to bearish territory here sooner rather than later. Let's take a look at some of the other indexes. The NASDAQ, you notice, is back to a red line. So you're back below by 2.5%, 2.8%, the 30-day moving average. So just like that, was having a hard time getting above it to begin with, and now is easily back below. Its intermediate line never did get into bullish territory. So you would not call this a bullish run for the NASDAQ. And then you can see long-term market sentiments actually dropping into the lower reversal zone, which we saw over here as well. Short-term sentiment, not only did it didn't dip its toe in the upper reversal zone, it dipped its toe in bullish territory for just a day, but didn't quite get the higher peak. This ended up being a lower high and a bearish peak on the NASDAQ. And then finally, let's take a look at the Russell. The Russell is more bullish. It's been dark green shading a green line for multiple days now. Is well above the 30-day moving average. Is still pretty far more above it than the other indexes at 3%. It is back below that 38% retracement. It had gotten more bullish on the rally than some of the other indicators did. It got back below this long-term 23% line that had just barely broke up above, and like I said, got back below the 38 and the 50 for that matter on the current intermediate decline. Of course, getting back below the moving average, getting back below 1740 throws the trend back into, like, now we're not retracing anymore. If you look at the SPX, it's still, it has to get back below the moving average to get back below the 23% line too. Remember, getting back below the 23% line throws now, again, we're not retracing, so you're either making a new impulse move to the upside if you're above 78, or you're making a new impulse move to the downside. And that would be a change in trend, of course, up there, and this would renew the trend, the long-term trend down here with that falling market sentiment. So obviously things looking relatively bearish. You can see it as well here. Let's go to this chart first. Here we go on the weekly chart. So we're back to a red arrow, so that means we're back below the 10-week moving average after getting a pretty decent bullish candle, closing above a lot of these highs here. We're running into the potential of not getting a higher close. So we got 38.27.54. We're at 38.28. Of course, we're trading right now at 37.59. So we're running in the potential of already not getting a higher close there to support this new turnaround. The PPO is still rising. Again, lacking the green arrow though. You can kind of see we're not as bullish just after one day. We weren't that bullish to begin with, but you can see what happens when you're not that bullish, right? We still have the 3 green arrows. So that's a good sign for the S&P and for the Dow and the Russell. The NASDAQ already has 3 red arrows. So just like that, we have 3 red arrows again. So we've had 3 greens. It was kind of a temporary move up to the upside here, about a few days here, a few days there, and boom, right back to 3 red arrows. If you take a look at the 2-line version of SPY, not only did we get back below all those Fibonacci lines, really important Fibonacci lines, we're also back below the 17-day moving average. The MACD is not below its moving average yet, stochastics is. A little bit of an increase in volume there. So we'll see if we maintain that dip below the 17-day, which would keep us going on a new bearish divergent move to the downside, directional move to the downside. And when you look at some of these other oscillators here, let's look at the Qs first before we move on. The Qs, you can see, is below that. All these lines is below that 23% retracement level. Remember, the Russell is not, and the S&P is not, but the NASDAQ is. It also got below its value area, which is a lot lower than a lot of the other indexes. Easily below the 17-day, never did get above the 50, and easily below the MACD is below its moving average. Stochastics is close to coming out of bullish territory. So you can see how bearish the NASDAQ is. And again, as goes the NASDAQ, typically goes the market too, and that's playing out here today. So a lot, very bearish pattern there. The S&P, you notice, remember the positive indicator never did get above 25. It's now back down. It's not quite below 20. And the negative indicator, excuse me, is not back above 25 yet, so it's not quite bearish there. If you look at the Qs, that is the case. So we are back below 20 in the positive. We are back above 25 on the negative. IWM was more directionally bullish, but now it's looking pretty tenuous there. Looking at some of these other indicators like the RSI, again, we never did get above 60, and we're already back below 50. We're almost back below zero there. The NASDAQ 100 is almost back below 40, so it kind of goes to show how bearish that is, well below zero. The Russell has been more bullish. It did get above 60, is now back down that easily, and the CCI is coming down too. Looking at the Ichimoku cloud, SPY so far is holding the cloud back below that green line. The Qs is back below the blue and the green lines, easily below the cloud, so nowhere near any kind of trend, any kind of a reversal there. And then IWM flirted with getting above the cloud yesterday, and now is back into the cloud and almost back below the cloud. Still above the green line, and you still got a trend going. You still got an intermediate trend strength going on the Russell. Hasn't broken yet, but you can kind of see the stages. The NASDAQ is by far the most bearish. The Russell is by far the most bullish, and that's not the combination you want to see when you want the market to go up, right? It generally is relatively bearish, and is one of the reasons why your on-balance volume has not been able to confirm the move on SPY. Let's go to SPY. Has not been able to confirm the move. As you can see, we're already at the this is the lowest level for the money flow for the year, for that matter, and we're not at the lows. So again, just no volume, and we're getting volume on the declines. We're not getting volume on the increases. It kind of goes to show, again, just how bearish we are, and how we're just lacking the strength and the breadth to get going to the upside. Here's that breadth indicator, McClellan oscillator we've been talking about. Again, to be as high as we are after being as low as we've been, to get back to minus 500 without a break above positive 100, especially when you've been below minus 100, again, is kind of showing is lacking in a lot of areas. So this, you can see how the strength of the market was not there. It didn't match what we saw in these numbers, as we talked about Friday and Monday, and that's the case. And we're seeing that play out now as the widely anticipated FOMC result is out. We're back. We're not in the upper quartile anymore. We weren't for the last couple of days, and now we are in the lower half of the bandwidth. So just like that, we're breaking below that line. We'll see if that continues. The Qs are in the lower quartile of the bandwidth. So just like that, it's bearish, and IWM is actually still in the upper half and hasn't quite rolled over yet. But again, none of those got above 100 when we really needed it to. From a volume standpoint, we saw the range was well above average. The volume was above average too. And so again, when those numbers start to move up higher, when you look at this here, when you look at the range here, they're moving back up. The ATRs never did cross below 2%. It's back up to above 2.25. The volume is moving up. It's bearish when we get those lines moving up. And the volatility actually didn't rise. So the volatility actually fell today. It got closer to 95% than we've seen. It stayed at 26, so it didn't really rise, and partly because the VVIX hasn't really started to take off yet either. But again, with the VIX at a low point relative to the VIX 3M, and the VIX itself at that 200, at its own 200-day moving average, with the VVIX as extremely low as it is, the VIX. With the VVIX as extremely low as it is, you're setting up the possibility of the VIX to take off, especially with the histogram rising. And again, of course, the VIX rising would be bearish for equities, would be more bearish for equities than what we've already seen. Obviously, a lower high and a lower low, easily lower close. We're getting into a gap of range. We're starting to move down towards last week's low. Again, getting closer down to these levels would solidify this change in trend, the ending of this bullish move that probably was a little bit more bullish than it should have been. And the beginning, and you can see the diamond, which has been the most bullish, big gap today, or get big gap and move there for some odd reason. But you can see it's got this gap to fill in here that it hasn't started to fill in yet, and it also has this gap from 1024 to fill in. So you can kind of get an idea. Neither one of those you would consider to be runaway gaps, so you would expect those to be filled in sooner rather than later. All right, let's take a look now what's driving the action today, and obviously we know what's driving the action today. So let's take a look at the charts and see what they're doing here, and we'll just look at today alone. There we go, November the 2nd. And you can see going into the day, the idea of a war in Iran with Iran and Saudi Arabia and some attack over there in the Middle East really pushed crude oil prices up early. You can see the initial reaction to the FOMC announcement was bullish for equities, especially international equities. But U.S. equities, again, also rallied too. Small cap stocks were down quite a bit going into the move, so were the Qs. They ended up rallying, pretty much flipping their returns from negative to the positive side. High yield bonds really took off as well, and then you can see bonds in general fell. They initially rose, but then they fell, and then they ended up falling a little bit more. Gold rallied initially on the move. The dollar fell like a rock. Well, by the end of the day, the dollar held up really strong. Commodities were the best performing asset class going in and coming out. The dollar flipped around and was the best, second best. And you can see IWM and the Qs down 3 1/3% both after the initial weakness surge and then the decline. Real estate also getting hammered to the downside. The S&P down 2.5%. International stocks holding up better, even with the strength in the dollar. Emerging markets holding up really well, again relative to the U.S. equities. Again, despite strength in the dollar, and gold dropping as the dollar rallied too. So that's the change in trend, right? We thought the dollar was going to turn down on that move. Ended up getting back above its 17-day moving average, almost back above the 30 as the MACD rolls up to the upside. You can see long-term bonds are still weak. The 10-year note was like on its way lower. People thought, oh, okay, it's going to get going to the downside again here. Ended up being above 4.05%, getting back above that 8-day. More than likely, it's got upside to it. That's the problem that we have. Is there's not a lot of downside to yields right now. You can see if I were just to look at the 1-day move on the 3-month Treasury, we went into it about 4.15%. You can see the FOMC announcement. It rallied initially, then fell down to 4.12, and then finished at 4.14. You can see the same thing with the 2-year Treasury. A little bit more volatility. We dropped like a rock from 4.55 down to 4.45 right after the initial announcement. Then now up to 4.6, and then of course the 10-year is the one we've been paying attention to quite a bit. Dropped down to 3.97 after the initial statement, and then rallying back up to highs of the day. You can see this yield spreads are at their lows that they've been at over the past year, down to 52 basis points between the 2-year and the 10-year. The spread between the 3-month and the 10-year is flat, so it's actually better, but still, just being negative at all is pretty uncommon for that spread. So the 3-month, was pricing in, easily pricing in 75, if not closer to 100 basis points at this meeting. It's still at that 4.14 mark, so kind of that midpoint between 4 and 4.25, right? Which obviously we're at 3.75 to 4 right now, so it's a little bit higher than where it typically is at an FOMC meeting. Again, pricing in an extra 25 basis points that we didn't get today. That we're probably going to get at the next go around, even though the futures market still is saying a relatively low probability. The odds dropped from where they were yesterday. They're higher than where they were a week ago. They're way higher than where they were a month ago, going into October. but they're not. They're still at 40%, so it's still in kind of coin flip area as to whether we get 50 basis points or 75 in December. And you can see whichever one we get, there's a 75% hike will be at, or 75% chance, that will be at 5% by February. So that would be, again, 100 basis points between these two meetings of rate hikes. And you can see that number is pretty relatively the same as what it was just a day ago, and higher. I mean, a month ago it was 0% odds that we were going to be at 5%, and now we're at 75. So more than likely by the beginning of next year, sometime by the beginning of next year, we're going to have 5% interest rates. Whether we get 75 and then at last 25, whether we get 50-50, whether we get 100 here in December to finally cool off. I guess it's going to depend upon jobs report that we get here, and then in December, and then the CPI numbers that we'll be getting now, and probably that day in December as well, the day of the FOMC meeting. Let's take a look at how the sectors move here today. So let's go to the sector comparison chart, and again, just look at today alone. And you can see again, utilities and utilities and industrials and financials were your best bets going into the meeting, and then all the way up to the very top. Utilities and financials ended up finishing with smaller losses. XLK, XLY, XLC are the biggest losers. They were lagging going in. They did okay after the statement, but they just got hammered. And again, that's not the three areas of the market you want to see get hammered. Those are the three biggest. I mean, those three going into yesterday at least still made up, even though they weren't the three biggest industries or sectors anymore. Healthcare is up there. Financials has gotten higher. But those three combined, even though they're not the top three, they are still a combined 45% of the S&P 500. And the fact that they are dark pink shading in a red line or close to it is not necessarily the thing you want to see. And again, looking at this ratio, let me update it here. Looking at the ratio of the Q's IWM and how it's easily breaking below the 200-week moving average with MACD. I mean, this is bearish to break, to be bearish in this indicator. It's bearish for the markets, bearish for risk appetite for this to be bearish. It's not the same as it was in 2021 when it dropped pretty hard here because of the reopening trade. That's it's in 2000 from 1999. If I were to just see how far we get here, you can see it dropped quite a bit here in 2000, 2001 during that bear market, when we also had a lot of sector weighting disparity in the technology area relative to other areas of the market. By the time we got to the beginning of 2003, this really fell. And then it continued down while we were bullish, but because we had different market leadership in those 4 years in between bear markets. This case, it's the same market leadership. It's not the same disparity, but pretty high. And you can see that a significant drop would most likely be, again, coinciding with more of a bear market in the S&P. All right, our trade idea today is in Norfolk Southern. Norfolk Southern looks very similar to a lot of stocks we looked at in our directional option strategies class. Remember, we already put this trade on in the Market Outlook Live here at 3:30 Eastern Time for all of our subscribers at marketscholars.com, our premium and our monthly subscribers. So the stock's actually down a few bucks since we got into it in just the last so many minutes of the market. So we'll take a look at that here in just a second. The link that popped out at the beginning of this segment, you can use to get to the Market Outlook Live. If you take a look here, obviously you have long upper shadow. You have the intermediate lines pretty bullish, but your near-term line, the momentum line, dipping pretty sharply here. If you look at the weekly chart, you had again a good bullish candle. You should have a green arrow. You're probably going to end up with a red arrow by the end of the week here, like you're seeing already on the S&P 500. You had 3 green arrows. You still have 3 green arrows, so the MACD is really rolling over here. Looking at the 2-line version of this chart is where it really stands out that we're at that 50-day moving average, the bottom of the value area for the full 1 year. There's a volume node here. The MACD is rolling over. The stochastics is peaking. So look, and again, a big closing below multiple lows here. Big bearish candle here with a long upper shadow is really bearish in and of itself too. In the last couple long upper shadows you can see one there, one over there. So those are the last really long upper shadows that you got on these bullish runs. So you can kind of see what the markets did with those. So that's what they do. Those are pretty bearish. When you look at some of the other oscillators, Norfolk Southern, you can see we didn't get above 60 on the RSI. If you look at the DMI for this, that we did get above 25, but not very strongly, and the negative indicator is down, but didn't dip below 20. So not really the most bullish pattern there either. Looking at the Ichimoku cloud, we held the cloud for resistance with no bullish trend developing and starting to roll over. You can see the 26-day rate of change is still positive, but moving down towards where that price is. You look at the Bollinger Bands. We never did get into the upper. We never did get into the outside the upper band, and now we're not in the upper quartile either, and we're already dropping down and again below the value area. So that's relatively bearish in and of itself. So you have, it's a pretty good bearish setup. So what we decided to do is to do a long put vertical spread. It's a $10 wide spread, so we only did the one contract, but we bought at the money, which at the time was at the money. Now it's not at the money. At the time it was at the money. We bought the 230, sold the 220. You can see that's how much we're already, it's already moved in our favor in just the last 15 minutes of the market or so, after we got done with the Market Outlook Live. And it's a high probability trade. It's almost double the reward for what I typically get for less than half the risk that I normally take. So a directional trade, lower probability, but a good reward to risk ratio. It's already working in our favor there. So kind of a safer trade because of the question is, like, if we do dip, which I think we will in the broader markets towards November expiration, when will we ultimately bounce, and will that bounce have already started by the time we get to December? So it limits where I think the downside might ultimately get to on this trade, hence the long put vertical and the relatively higher probability version of that directional trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free. Like us on Twitter and Facebook as well. Have a great rest of your night, Wednesday night, everybody, and we'll see you all next time.